There is something that almost never makes the financial news, but it explains nearly every bad money decision you have ever seen or made yourself. The question is not which asset you choose. It is not which strategy you follow. It is not even how much money you start with. The question is whether you make financial decisions based on data or based on what everyone else around you is doing, because those two things almost never point in the same direction. And at the extreme moments, the panic moments, the crisis moments, the everyone is getting out moments, one group ends up building wealth while the other group spends years explaining why they sold right before the recovery. There is a research firm called Dalbar that has been tracking investor behavior for over 30 years. Their annual study compares what the average individual investor actually earned against what the market returned during the same period. The gap is not small. Over the last 20 years, the S&P 500 returned roughly 10% per year. The average equity investor returned around 3.5%. Same market, same time period, different outcome. The money was not the problem. The decisions were. And the research shows those decisions were driven almost entirely by one thing: emotional reaction to what the crowd was doing at any given moment. Buffett said it plainly. Be fearful when others are greedy. Be greedy when others are fearful. Most people have read this. Most people nodded. Most people then did the exact opposite when the real moment arrived, when the chart dropped, when the headlines screamed, when everyone around them was hitting sell. The principle makes sense in theory. The execution collapses under pressure. This video is about why that collapse happens, why it is predictable, and why silver right now is sitting right in the middle of that pattern. If you have never heard money explained this way before, subscribe to this channel. This is where we break down how the financial machine actually works. October 2008. Lehman Brothers had just filed for bankruptcy. The stock market was in free fall. Financial channels were running wall-to-wall coverage of a system that looked like it was coming apart at the seams. Pension accounts were melting. Banks were refusing to lend to each other overnight. People were watching the number in their retirement portfolio drop by double-digit percentages week after week. Unemployment was rising. Nobody knew where the bottom was. And in that environment, one behavioral outcome was almost perfectly predictable. The crowd was going to sell. Silver had been trading around $18 an ounce in early 2008. When the full panic arrived in October, the price dropped to $9, cut nearly in half. The chart looked terrible. The news was terrible. And the crowd delivered the same verdict it always delivers in those moments: get out before it gets worse. That reaction was understandable. When everything around you is collapsing, holding a chunk of physical metal feels like stubbornness. It looks like denial. The rational seeming thing, the thing that everyone around you agreed on, was to cut losses and move somewhere safer. Here is what actually happened next. Silver spent the following 2.5 years recovering. By April 2011, it had reached $50 an ounce, from $9 to $50. That is a gain of more than 450% from the panic low. The people who sold at $9 locked in a loss and exited before one of the most significant silver bull runs in modern history. The people who held, or who bought more when the price felt the worst, watched the same asset that looked like a disaster become something else entirely. Think about the math for a second. Someone who had $1,000 in silver in early 2008 watched it drop to $500 at the bottom and sold. They walked away with $500. They told themselves they were being smart. Someone with the same $1,000 who held through the drop and sold near the 2011 top walked away with around $2,800. Same starting position, same asset. The only variable was what they did during the part that felt the worst. The crowd exited. The patient investor did not. 10 years later, one of them is telling a very different story. Now here is something most people miss about why the crowd behaved that way. Behavioral researchers have a name for the mechanism: loss aversion. Kahneman and Tversky demonstrated this decades ago. The psychological pain of losing something is roughly twice as powerful as the pleasure of gaining the equivalent amount. So a $500 drop in your portfolio feels emotionally like a $1,000 gain would need to feel to balance it out. Your brain is not being irrational when it tells you to sell. It is doing exactly what it was built to do: protect you from perceived threats. The problem is, that system was designed for physical danger, not for markets. In markets, the threat response destroys wealth. Some people hear the 2008 story and immediately say, that was a different world, different economy, different crisis. The trigger is always different. The specific numbers change. But here is what the data shows across every major market panic in recorded history, from the dot-com crash in 2000 to the financial crisis in 2008 to the COVID crash in 2020. The psychology is identical every single time. Crowd moves together in one direction. Prices collapse. Crowd accelerates the exit. Prices bottom. Crowd stays out or moves elsewhere. Prices recover. Crowd returns, near the top, after most of the gain already happened. This is not bad luck, and it is not coincidence. It is a measurable, repeatable behavioral pattern. Every serious long-term investor has recognized it and used it to their advantage. And right now, in 2025, if you search for silver in mainstream financial media, you will find almost nothing. No major headlines, no analysts on television getting excited, no viral enthusiasm in personal finance communities. The crowd has largely moved elsewhere, which, if you understand the pattern, tells you something important about where the opportunity is pointing. If you see the pattern in what we just walked through, write in the comments, "I don't follow the crowd." This is the mindset that separates investors from spectators. In 1997, Berkshire Hathaway began quietly purchasing silver. Between July 1997 and early 1998, Buffett accumulated approximately 129.7 million ounces, roughly 30% of the world's above-ground silver supply at the time. The price ranged between $4 and $6 an ounce. Nobody was writing excited pieces about silver in 1997. No mainstream commentator was calling it the trade of the decade. Silver had been flat and largely ignored for years. The crowd was not here, which is exactly why Buffett was. When Buffett disclosed the purchase in 1998, his explanation was straightforward. For an extended period, silver production had exceeded demand, building up excess inventory. Eventually, consumption had begun to outpace production, creating a supply-demand imbalance that the price had not yet reflected. In plain terms, the fundamentals said one thing, the price said another. And Buffett understood, as he always has, that the gap between what an asset is actually worth and what an emotional crowd will currently pay for it never lasts forever. The crowd sets the price, the fundamentals set the ceiling. Ben Graham, Buffett's mentor, had a concept that explains why this works. He called it Mr. Market. Graham described the market as a business partner who showed up every day with an offer, to either buy your share of the business or sell you his. Sometimes Mr. Market is optimistic and names a high price. Sometimes Mr. Market is terrified and names a price far below what the business is actually worth. Graham's instruction was simple. When Mr. Market is scared and names a price below value, you buy. Not because the fear is irrational in a technical sense, but because the fear is not a reflection of the underlying value. It is a reflection of the crowd's current emotional state. Something in you already knows this intuitively. You have felt the pull yourself, the urge to sell when everything is dropping, not because you analyzed the fundamentals and concluded the asset was overvalued, but because the crowd around you was selling, and the feeling of holding something the world seemed to be abandoning was uncomfortable. That discomfort is real. It is not weakness. It is your brain trying to protect you. But in markets, the protection mechanism consistently pushes people toward the worst possible timing. The crowd creates the panic creates the exit creates the opportunity, and the people who understand that cycle, like Buffett, are the ones waiting at the door when everyone else is rushing out. Think about it like this. Every November, electronics stores run massive sales, 40% off televisions, 30% off laptops. People camp outside at 4 in the morning. They share the deals on social media. They are proud of what they bought at the reduced price. The lower the sticker, the more excitement builds. Now take that exact same logic, buying something quality at a discount, and apply it to silver dropping 30%. The reaction from the same people is not excitement, it is fear. The asset did not change. The crowd's emotional relationship to the price changed. One of these reactions builds wealth, one of them destroys it. This behavioral pattern has a name. Call it the panic exit. The moment arrives, a news event, a chart drop, a friend saying they sold, and the crowd rushes for the same door at the same time. Prices collapse, not because the fundamentals collapsed, because the volume of the panic collapsed them. And when everyone exits through the same door at the same moment, the price on the other side of that door has almost nothing to do with what the asset is actually worth. Buffett built his career on one thing more than any other, recognizing the panic exit for what it is. Not a signal to follow, a signal to go the other direction. If this is opening your eyes to how money really works, let me know by liking this video. It helps more people find this content at the right moment. Here is the data that most of the crowd is not looking at right now. According to the Silver Institute, the silver market has been in a structural supply deficit since 2021. In 2023, that deficit reached approximately 184 million ounces, the second largest on record. That means the world consumed roughly 184 million more ounces of silver than it produced that year. This is not a projection, not a forecast built on optimistic assumptions. It is the measured gap between mine supply plus recycling on one side and total demand on the other. The gap is large, it is growing, and it has been expanding while the crowd's attention has been pointed somewhere else. Start with the consequence and then work backwards to understand why. Solar panels account for roughly 140 million ounces of silver demand annually, based on 2023 installation data, about 14% of total global supply from a single application. Each panel uses approximately 20 milligrams of silver as a conductive coating on the cells. That number sounds small until you multiply it by the hundreds of millions of panels installed each year worldwide. And the direction is not ambiguous. Global solar installation targets are increasing year over year as governments and energy companies commit to decarbonization timelines. The industrial demand curve is not speculative. It is already embedded in policy and infrastructure investment. Electric vehicles add another layer that compounds the picture. The average EV uses roughly 50 to 60% more silver than a conventional internal combustion vehicle. Somewhere between 1 and 2 ounces per car versus about 1 ounce in a traditional vehicle. In 2023, global EV sales hit approximately 14 million units. Industry analysts project that number reaching 40 million by 2030. Silver also appears in semiconductors, 5G antenna components, water purification systems, medical equipment, and antibacterial coatings. The industrial case is not built on future speculation. It is built on what is already happening in products that are already being manufactured and sold. On the supply side, the math does not offer a quick solution to the deficit. Silver mine production has been relatively flat for several years. Most silver is extracted not from primary silver mines, but as a byproduct of mining other metals: copper, gold, lead, zinc. That means ramping up silver supply requires ramping those other mining operations first, which takes time and capital entirely driven by demand for those other metals. Primary silver mines are aging. New discoveries take 8 to 12 years from exploration to production. Even a producer who decides today to build a new silver mine in response to the current deficit cannot solve the supply problem before the mid-2030s at the earliest. The deficit does not fix itself quickly. Here is the historical context that gives the supply picture additional weight. The gold-to-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, sits at around 85 to 1 as of 2025. The historical average over the last century is closer to 45 to 1. At certain peak demand periods, the ratio has compressed to 15 or 20 to 1. The current ratio does not guarantee silver will close the gap quickly. Nothing guarantees anything in markets, but every time in recorded history that this ratio has stretched to its current levels, it has eventually compressed, sometimes dramatically. The ratio is not a trading signal, it is a long-term context that tells you something about relative value between two monetary metals. Pay attention to this one. Media coverage of silver right now is minimal. Search for silver in any major financial publication today. You will find commodity price tables, maybe a brief mention in a precious metals roundup. You will not find the breathless coverage that surrounded crypto in 2021. You will not find the wall-to-wall analyst commentary that shows up when the crowd is excited about something. You will not find viral posts or trending social media conversations. The crowd has moved on. The algorithms are not pushing silver content. The silence in the media is not evidence that nothing is happening fundamentally. It is evidence that the crowd is not paying attention. And for the investor who understands the Dalbar research, that silence has a specific name, Signal 1. If you understand the theory, but the gap between knowing and acting still feels enormous, check the first pinned comment below this video. It is there for people who are ready to stop watching from the sidelines. Let us put this into a framework that is actually usable. When Buffett talks about being greedy when others are fearful, the challenge for most people is not understanding the concept. It is recognizing when the fearful moment has actually arrived. How do you know the crowd is at an extreme? Here is a 3-signal system that holds up across multiple market cycles. Buffett has referenced the underlying logic in his shareholder letters. Call it the crowd signal. When all 3 align, you're looking at the kind of setup that patient data-driven investors wait years to find. Signal 1 is media silence. When an asset is approaching or sitting near a fundamental value inflection point, the mainstream financial media has usually stopped covering it consistently. Not because there is nothing happening, but because nothing happening is not a headline. Stories need excitement, fear, or controversy. A commodity sitting in a supply deficit while the crowd sleeps somewhere else is not a story until it moves. So you look at the coverage profile. Is this asset getting front-page treatment, or is it buried in the commodity section? Silver in 2025 is buried. That is not random. That is a measurable condition. Signal 2 is ETF flow data. Exchange-traded funds that hold physical silver, funds like the iShares Silver Trust, give a real-time view of what retail investors are actually doing with their money, not just what they say they believe. When these funds show consistent net outflows over a multi-month period, it means the crowd is actively exiting the position, not in a panic, quietly. No drama, just consistent selling. Tracking this does not require specialized financial data. It is publicly available. And when outflows are consistent during a period of structural supply deficit, that is a specific kind of disconnect between crowd behavior and fundamental reality. Signal 3 is retail sentiment. This one is softer but trackable. Google Trends data for search terms like buy silver or silver investment. Traffic reports from coin dealers and bullion retailers, many of which publish their own demand data. Conversation volume in personal finance communities and forums. When all of these are quiet or in decline, while the fundamental picture is unchanged or improving, you are watching the crowd lose interest in something that has not changed. This has preceded every major silver bull run in the last 50 years. The crowd leaves. The fundamentals stay. Then the crowd returns at higher prices. Look at where all three signals sit today. Financial media coverage of silver is minimal. Silver ETF flows showed significant net outflows through periods of 2023 and 2024. Google search interest for silver-related terms is well below the peaks of 2020 and 2021. Meanwhile, the Silver Institute is reporting its fourth consecutive year of supply deficit. Industrial demand is growing structurally. The gold-to-silver ratio is historically stretched. Three behavioral signals pointing in one direction, fundamental data pointing in the other. This is what Buffett means when he talks about price and value diverging. The crowd is not here. The fundamentals are. Some people hear this and immediately say, "But look, trying to time the market is a fool's errand." Even Buffett has said no one can time the market consistently, and that is entirely correct. But the objection misses what this framework is actually describing. Market timing means trying to identify the exact bottom and exact top and moving perfectly between them. Nobody can do that. What the crowd signal describes is something categorically different. Identifying when crowd behavior has pushed a price significantly below fundamental value and positioning yourself there. Not because you know the precise bottom, but because you know emotional extremes create gaps between price and value that have nothing to do with the underlying asset's actual worth. The distinction comes down to the question you are asking. A market timer asks, when will the price go up? A contrarian investor asks, does this price reflect value, or does it reflect panic? Buffett does not know when silver will move. Nobody does. What he has demonstrated over 60-plus years is that assets with strong fundamentals, accumulated during periods when the crowd has abandoned them, tend to deliver outsized value when the crowd eventually returns. And the crowd always returns. The question is not whether they come back. The question is whether you were already positioned when they did. Here is what the practical version looks like. You do not need to make a large bet. You do not need a brokerage account or a financial advisor or a significant amount of starting capital. Buffett once told a group of students that the best investment they could make was in themselves, and that wealth building starts with small, consistent actions repeated over time. The power of consistency compounds. And in an environment where the crowd has largely stepped back from silver, small and consistent is exactly the right posture. For physical silver, the most straightforward entry points are American silver eagles, Canadian maple leafs, or generic silver rounds from established dealers. Eagles and maple leafs carry slightly higher premiums above spot price, usually $2 to $4 per ounce, because they are government-minted, widely recognized, and highly liquid if you ever need to sell. Generic rounds from reputable mints cost less per ounce and still hold value. Starting with 1 or 2 ounces is completely reasonable. The point is not to make a life-changing purchase immediately. The point is to build the habit of converting a portion of your currency into something that the crowd is currently undervaluing. Dollar cost averaging. 3 words that remove the need to call any bottom. If you have $50 a month, that buys you roughly 1.5 to 2 ounces at current prices. Do it for 12 months. You have accumulated 18 to 24 ounces without ever trying to identify the perfect moment to enter. Some months you buy slightly higher. Some months slightly lower. Over time, your average entry cost smooths out across the price range. Not the panic price, not the headline price. Your deliberate, consistent price. If the supply deficit thesis plays out over the next several years, the difference between your average entry price and the crowd's eventual re-entry price is where your return comes from. Let me ask you something honestly about the risk. If you are wrong, if the silver supply deficit closes faster than expected, if industrial demand slows, if some technology reduces silver's role in solar panels, What is the realistic downside? The price does not reach the levels the fundamentals currently suggest, and you hold an asset with a 5,000-year track record as a store of value and a genuine hedge against currency debasement. If you are right, if the deficit continues, if industrial demand scales with the energy transition, if the crowd returns to silver the way it has after every prior period of indifference, what happens? The asset you accumulated during the quiet period becomes significantly more valuable. That asymmetry is exactly the kind of setup Buffett has consistently identified and acted on throughout his career. Now here is the patience component, because this is where most people give up too early. Silver does not move in straight lines. Nothing does. Buffett accumulated silver between 1997 and early 1998. The price did not immediately reward that decision. For years, silver traded in a relatively flat range, not exciting, not generating headlines, just sitting there. Then between 2002 and 2011, silver went from roughly $4 to $50, a 12-fold increase. The investors who needed to see results within 90 days exited before the gain existed. The investors who understood they were positioned for a multi-year fundamental thesis held through the flat years and participated in the entire move. Picture two people, same income, same information, both watching the same situation in 2025. Both have access to the Silver Institute data, the Dalbar study, the ETF flow reports, the gold-silver ratio. One of them says, "The crowd is not excited about silver right now, so I will wait until it becomes a bigger story before I look at this more seriously." The other one says, "The crowd is not excited about silver right now, which is exactly why I am starting to accumulate." 5 years pass. The story either develops or it does not, but the entry price of these two people is completely different by the time the story is visible enough for headlines. Here is where the first person ends up. They wait through 2025 and into 2026. Silver is quiet for a while. Their caution feels validated. Nothing dramatic happens quickly. Then, a supply shock, a technology demand acceleration, a combination of pressures, prices start moving, headlines appear. Suddenly, the mainstream financial conversation includes silver. Now the first person is interested. Now they are excited. Now they are ready to buy. But the price in the headlines is 40–50% higher than it was in 2025, when the data was pointing directly at this setup. They buy at the crowd re-entry price, not the contrarian price. The gap between those two prices is the cost of waiting for confirmation. Look at what recorded history shows about every major silver move. The move is almost never previewed by mainstream media before it begins. The signal arrives in the fundamentals: supply-demand data, monetary context, patient capital positioning. The Hunt Brothers Corner in 1980, the 2002 to 2011 industrial bull run where silver went from $4 to $50, the recovery from the COVID crash in 2020. Every single one of these moves followed a period of crowd indifference or active selling. The crowd created the low price by leaving. The crowd then missed most of the gain by staying away. Then the crowd returned near the top and told the story afterward as if they had been paying attention all along. Some people ask at this point, why silver specifically? Why not just keep buying index funds or cryptocurrency? These are fair questions, and they deserve a direct answer. Silver is not a replacement for a diversified approach to building wealth. It is a component of one. The case for silver is not that it outperforms every other asset in every environment. The case is specific. It is a real, physical, industrial asset with a growing supply deficit, 5,000 years as a monetary store of value, and a current market price that reflects crowd indifference rather than fundamental reality. That specific combination of conditions does not exist for most assets most of the time. The comparison to crypto in 2021 is instructive. At that peak, retail enthusiasm was at historic highs. Social media was flooded with content about life-changing returns. Google search trends for Bitcoin were at all-time records. Influencers were promoting it to audiences who had never previously considered financial assets of any kind. That is not a contrarian setup. That is a crowd at peak setup, the moment the opportunity has already been priced in by the crowd's arrival. Silver in 2025 has the exact opposite profile: low public enthusiasm, minimal media coverage, structural supply deficit, historically stretched gold-silver ratio. One of these describes an asset the crowd is abandoning. The other describes an asset the crowd was crowding into. Buffett built his entire career on knowing the difference between those two situations. And here is the concept that ties the whole picture together. Call it the quiet side. Every major move that creates meaningful wealth has a quiet side. The period before the crowd arrives, when the fundamentals are in place, but the excitement has not built yet. Apple had a quiet side. The years before the iPhone, when most investors ignored the company or wrote it off. Amazon had one. The years when analysts called it permanently overvalued while it was quietly building infrastructure nobody else had. Silver's last major quiet side was the period between 2002 and 2005, when the price was flat, the media was silent, and patient investors were accumulating ounce by ounce. The crowd does not recognize the quiet side until it has already ended. The people positioned during it participate in the whole move. The people who waited for confirmation participate in the tail. Here is the pattern in the clearest terms possible. Emotional decision-making is predictable. It follows the same script every time, in every market, across every generation of investors. The crowd buys based on how things feel. It sells the bottom not because the fundamentals deteriorated, but because the feeling of holding something that is falling became unbearable. And because the pattern is predictable, it is also avoidable, not by being smarter than the crowd, but by using a different input, data instead of feeling, fundamentals instead of fear. The Dalbar research does not show that bad investors are bad people. It shows that normal human psychology, applied to markets, produces consistently bad outcomes. Understanding that mechanism is the first step to stepping outside it. Buffett has one phrase that cuts through all of the noise. Price is what you pay. Value is what you get. The crowd determines the price. They always have. In normal periods, price and value roughly track each other. But at the extremes, in the panic moments, the abandonment moments, the everyone is selling moments, price and value can diverge dramatically. The crowd's emotional state drives the price down to levels that have nothing to do with what the asset is actually worth. That gap is exactly where the investors who study the data, instead of following the crowd, tend to show up. Not because they have a crystal ball, because they are asking the right question. The crowd will panic again. It always does. The next trigger will be different from 2008, different from 2020, different from every prior moment. But the behavior will be identical, because human psychology does not update between market cycles. What Buffett understood as a teenager, reading every financial book he could find in the Omaha Public Library, and what he still demonstrates now managing the largest private investment portfolio in the world, is this. The most reliable edge in investing is not intelligence. It is the willingness to act when the crowd is afraid, and to wait when the crowd is excited. You watched this when the crowd was not watching. You now have the Dalbar data, the 2008 template, the Silver Institute deficit numbers, the Buffett contrarian framework, the crowd signal, the quiet side. You have a way of thinking about price versus value that most people watching financial content right now do not have. The question is what you do with it from here. If you stayed until the end, write in the comments, "I choose value over noise." There is another video ready for you on screen right now, the next step in understanding how money really works. Thank you for watching. We will see you in the next one.